Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Abha Bakaya and our guest on the show today, Amit Jeswani, the successful fund manager at PMS House Stallion Capital. Amit, great to have you on the show. I see today that many fund houses, many PMS schemes have quite a bit of cash running on their books, including you. Has the market up moved to 18,200 Nifty, etc.? Come as a bit of a surprise then? Is there even a feeling that the market might be a bit ahead of itself?
So good evening, Udayan. Good evening, everyone. Thank you so much for calling me on this show. Udayan, this cash is for the earnings season. The markets are moving quarter se quarter tak. And the quality of the rally for the last 2 months has been very surprising. It's the neglected stocks which are doing well. The PSU banks, sometimes at the defense companies, now the railway PSUs are doing very, very well. So the quality of stocks that we typically look out for, the ones which are growing at 20-25%, can reinvest capital at 25-30% ROICs, they've just stayed where they are. So the quality of rally in India is gone a lot more weaker than what we would be happy with. And 73% of quarterly numbers which have come down, the stocks are down more than 5%. Just tells you, if you're not a PSU bank, the markets are bidding you down on any kind of quarterly number. If it's very good, then the stock will be down probably 2%. If it's bad, then you're down 7-8%, which happened with DVs today. Yeah.
No, this is an interesting observation, Amit. Is this making you suspicious of this rally, and is it a painful phase for a fund manager now, where you may be forced to think of whether to include some of these questionable quality stocks just to be able to keep up with the market, or are you sticking to your horses and saying you will not dilute quality, even if that means underperformance in the near term?
It's very tough, Udayan, I should tell you, because if you look at the last, one utility company has gone from 1% of the market cap of Nifty 500 market cap to now 10% of Nifty 500 market cap. So you will basically the only way you outperform the benchmark is go even lower on the quality cycle. What we have, so that is very tough for any fund manager, and it's a view which every fund manager has to take. What we have done is we've also somewhat gone down a little bit, 5% of our portfolio down the quality curve. But the 95%, we're still confident that companies which grow at 20, 25, 30% can reinvest capital at 25, 30%. That is where large long-term capital will be made. We cannot invest in banks where ROAs are less than 1%. Like SBI was, for the first quarter, did an ROA of 1%. Even if you're leveraged 10x, over long times. Of course, SBI has leveraged a lot more. Bank of Maharashtra has leveraged 17 times the book value of Bank of Maharashtra, and now Motilal is doing a roadshow for it. So this tells you that over time, if the price moves higher, everyone starts chasing those kind of plays. Like book value of Bank of Maharashtra 4 years back was 73 rupees. Last year it went down to 3 rupees. And now, since the government invested 10,000 crores, the book value has gone to 18 rupees or something. And basically, these are not the kind of stocks you want to stay invested for long periods of time. You will have to go through a tough cycle, which we are already, but it's already been 1 year, like growth globally, not just in India, has underperformed. And of course, the first thing was to get rid of the loss-making companies, which of course, globally, there's no trend out there. But I am very confident that 2023, these kind of stocks will bounce back, and people who are flirting with very low quality companies may make money for next 1-2 quarters because they need to follow the trend, but these are not long-term decent bets. So globally, no large wealth creation happens in B2G company. That's the worst place to get your money invested in. The government doesn't care about shareholders. Their focus is and should be on public good.
So what is the right way to look at this leg of the rally? I mean, is it telling you in any way that the nature of the market has changed to focusing on lower valuations and underperformers now, and fund managers will have to include them in their basket? Or, as it has often signified in the past, it could be the last leg of the upcycle, current up move, where lower quality begins to outperform?
So this is the time where low quality rallies don't last too long. They're very, very, very painful. Typically, they don't last too long, but the numbers of low quality companies are good. Like a South Indian bank, the NII growth is 37%, right? So there is a number backing also. The defense stocks also, the numbers are very decent. So it's not, this rally has not happened without numbers. So it's not going to fizzle out so quickly till the time the numbers are with them. So do we have to go down the quality curve like as a portfolio to outperform the market? If your horizon is 3 years, then you don't have to go down the quality curve. You still buy decent companies which can grow decently, because if your earnings doubles 3 years, I can with a lot of conviction say that so will your stock price. It might be 20-30% lesser, but that should be your trajectory. But yes, let's see. Udayan, this is the most difficult, I would say, 6-8 months, 9 months that we've seen in the 9-10 years of investing that we are doing aggressively. So because it's a very tough call that you have to take, that do you go down and protect your alphas, or do you not go down to protect your alphas? For now, the ones who've gone down the quality curve, they've done very, very, very well. But over long periods of time, like a 3-4 year period, there will be drawdowns, and if they cannot exit on momentum breakdowns, they will, like example for Adani, for any stock, you need to have stop losses if you are going down the quality curve. So we are also looking at strategies, but we are not so convinced to go down the quality curve.
I want to get your view on financials. Amit, at a time like this, everyone's so gung-ho, and look at the recent spate of earnings, and the interest is spreading from private names to PSUs as well. What's your strategy when you're looking at the BFSI segment of the market?
So, Abha, we were broadly underweight BFSI till now. Since COVID, we've been underweight. We're looking to add. We've been buying, like Axis used to trade at a massive premium compared to ICICI throughout last decade. Of course, the last 3 years, ICICI did very well. Axis was a laggard. But now if you look at the ROEs of Axis, they're now equivalent to that of ICICI Bank. The NII growth of Axis was 31% this quarter. NII growth of ICICI was 26%. And HDFC Bank, the net interest income growth was 18%. So HDFC is of course lagging, is now probably, if you take Bandhan out, the slowest NII growth this quarter is for HDFC Bank. No recommendations. We might have vested interest in these kind of names, but you need to look at the value part now. So as Udayan rightly said at the start, that we are also repositioning more towards the more cheaper, but still decent quality. You still don't go very down on the quality curve by buying a Bank of Baroda or a Canara Bank. You're still in decent quality, but that is what we're doing. Like something like Axis, we added this quarter after the numbers came in. So that is the only game left in town, for us fund managers. Because if you start going down the quality curve, the game never stops. You go down the quality curve, you make money in one stock. The second stock, you'll do the same thing, and there probably you'll make money. The third time you do this and you lose whatever money you made in the last 2 times at one go. The question is not if, the question is when, and that will happen for sure in low quality. We've done that before. It's a very painful thing to exit then low quality.
But the dominant holding in the BFSI space for you is Bajaj Finance, almost 10% of your portfolio. But how do you think that name holds up in a context where many of these deleveraged banks like ICICI and Axis are raring to go with a new credit cycle?
So Bajaj Finance will continue, in my humble opinion. If you look at the ROAs of Bajaj Finance, that's closer to 5.4% this quarter. And that is after 1/3 of the book is housing. So at some point of time, I do expect Bajaj Housing and Bajaj Finance to get demerged. So the ROAs of Bajaj Finance, basically the retail lending ex housing finance, would be closer to 7.5%. And the ROAs of housing would be closer to 2%. That is how, in my humble opinion, they don't give these kind of disclosures, but this is how the ROA stacks up. Bajaj has gone through bad times. It's still 1.5%, 2% of India's credit market. We expect this will be the fintech player also. in India. So we expect the growth to continue at 2 times the normal credit growth of the economy. 2-3 times. If you get 2-3 times the normal credit growth of the economy with a 25% ROE, and you've gone through COVID, so you've seen what happens. The worst is already known, right? There cannot be a credit event worse than COVID. So these are kind of bets that we keep adding on bad times, actually. That's all we have to do. As long as the growth is 2 times faster, they're gaining market share, the credit quality is good, you don't touch these kind of investments. We've been holding Bajaj Finance for a long time, but we still expect that we should make decent compounding here. And it will lead the technology play as well. The profits this quarter were 2,700 crores. I expect Q3 and Q4 will be better. So Bajaj Finance will make 11,000-12,000 crores of profit easy in FY23. And the game keeps, it's a great compounding machine. You don't get stocks like Bajaj Finance. It doesn't get created. And Bajaj Finance keeps pivoting from one profit pool to another. It started as an auto finance guy, pivoted to consumer finance, then pivoted to housing finance. You need these kind of players, and now he's pivoting to technology. So as long as Rajiv Jain is there, we don't intend to, of course, these are just till today. If some new information comes which we don't know or can't think about today, we might change our views. But for now, Bajaj Finance remains the dominant play in our portfolio. It's our kind of stock. We love companies who are gaining market share quarter over quarter. Then there is no credit risk over long periods of time. It's your credit risk which will dominate, because only the last 3, 4, 5 EMIs in a financial business are your real profits. So very few guys can have been able to do what Bajaj Finance has been able to do in consumer credit. So we remain optimistic on Bajaj Finance.
Of the course, other space that you seem to be holding your confidence is consumer discretionary. Yeah, of course. I mean, your disclosures are taken. But what I was saying, Amit, is, the consumer discretionary space is something that you continue to be optimistic on, apparently, because you hold not just Titan, but even names like Campus and Maneuver in your portfolio. But tell us where this confidence is coming from.
So if you see that the pattern, there's a framework that we use. We'll buy companies which are gaining market share in the consumer space. Like Campus is gaining market share. The revenues of Nike in India is 700 crores. So if you think about it, the above 2000 shoe category, there's a red ocean out there where Nike, Reebok, Adidas, Skechers, and so many other brands are fighting against each other in the 2,000 to 10,000 rupee category. Nikhil Agarwal has created a nice category of its own, where the ASP is the average selling price for Campus shoes is 600 rupees, and they make a cool 49% gross margin. That means they buy something at 300 rupees and they sell something at 600 rupees. Beyond 2-3 crore Indians, they cannot afford the 2,000, 3,000, 5,000 rupees shoes. So that's a category which Campus has created. They sell shoes between 800 to 1,500. That's where majority of shoes get sold on retail. But there's a supply which is coming in. So we've cut some weights before the supply, and we might buy again. So this is public data broadly, that there's a supply coming in Campus, but we like the way Campus is gaining market share. It's now in FY23, Campus will be 2 times bigger than Nike, 4 times bigger than Reebok. And you've seen what Relaxo has not been able to scale up the shoe business at all. And so is the case with Maneuver. Maneuver is not number one in its category. It's the only one. And we got in with the IPO. That has done well. Of course, these stocks are not cheap anymore. You need to wait for dips to get your entry points. But these companies will keep growing at 15-20%. We've got other players also, companies like APL Apollo, where the market shares have increased from 35% pre-COVID to now 55% in the structural steel tubes category. So we look at industries where the growth is 10-15%, which is the case with every industry in India. But the player that we own needs to grow 2 times faster than the industry and deploy capital at very high ROIC. On average, this strategy outperforms the benchmark in every 3 years by a very large margin. So that is our strategy. And we love consumer facing businesses. The quality of earnings, so valuations are not created based on earnings only. It's based on your consistency of earnings growth. And these are the kind of companies where you have very large predictability of earnings growth. We are at $2,000 per capita. So you get a very large terminal value in these kind of stocks. Of course, we don't like buying them expensive, but we rarely get them cheap. And when we get them cheap, we go out with a bucket load, basically. And that's the case with Safari also, which we have in our portfolio. Safari, so I have never so we study consumer stocks very closely. We have never seen the world number one getting defeated, India's number one getting defeated by a value player, which is Safari in this case. And till now, they were importing everything from China and Bangladesh, so because of that, your ROICs were 15%, 16% for Safari and VIP, etc. But now they would be making in India. So your inventories goes down and your ROICs for Safari would be near 30%. Not just the ROC, the growth rate. If you look at how Safari has scaled against VIP, you will see there's a clear market share. Safari has grown basically 3 times faster than VIP. So, and India's bag market is 20,000 crores. That's the size of India's luggage market. VIP will do 2,200 crores this year. Safari should do closer to 1,700 crores this year, and American Tourister will be 1,200 crores. So, all 3 players combined are still 20% of the market or 25% of the market. There's a large growth runway ahead of them, and Safari is the player who we backed in this because it's gaining market share every quarter. So Udayan, we follow a pattern where we buy companies who are gaining market share quarter over quarter, and as long as they keep doing that, we keep holding them.
Amit, since you seem that like you're in the mood, I'm going to try and get some more stock plays from you in terms of anything else that you've added of late to the portfolio that you are can speak freely about, and what's making you bullish about that said company.
So Abha, we will see a 1 lakh crore odd supply in the next 1 month. So these are very interesting, desperate sellers that will come in the market. I'm speaking about some tech names, some non-tech names, some hospital plays. There's a very large supply unlock which will happen, and it's going to be about worst case 50,000 crores of supply which is going to hit the market. And if you get decent quality companies who are market leaders, who are growing at 20, 30, 40%, at reasonable valuations. Now, you can know the cash levels. Like today, Policy Bazaar cash per share is 100 rupees. Paytm cash per share is 150, 180 rupees per share. And that is after burning cash. If they burn all it out, so there are going to be desperate sellers. And you need to see at what price is your worst case price that you're willing to pay. And if you get it at those valuations, you'll get a decent ride. Now, you don't know which of these business models will become large and which of these business models will not become large. Basically, we in the consumer tech space, we are in a 42-kilometer marathon, and we are basically reached the first kilometer of the marathon. And we are all trying to predict who's going to be the next winner. If we get very large margin of safety, that is where we start looking at the loss-making companies, or else we won't look at the loss-making companies. But you've got good quality supply coming in, some hospital stocks, some shoe stocks, which I spoke about. Okay. Those are times to add these kind of players. So that is where my focus is, and that is why we've kept the 8% cash that we have on the portfolio. Also, if we get, so that's the strategy.
We spoke about consumer discretionary, Amit, but the other space that you seem to be quite confident about or bullish about is retail, because you own DMart and Trent. These valuations don't seem daunting to you.
So DMart should have an EPS of 44 in FY23. We've already made a 60% odd CAGR in DMart. I don't think so we'll be able to make a 60% CAGR for the next 5 years of our journey in DMart, but we'll probably have to make a 20-25% kind of CAGR, but that CAGR rate will sustain. This is what we feel. We've cut our allocations in DMart, but we are still, it's one of our top 5 holdings, I would say. So we've cut our allocations when DMart had a melt up towards 5,000 rupees. And yes, now if DMart goes down a lot, we buy. If it goes up a lot, we sell. It becomes a normal compounder kind of play. from here on. But unless we get a company which is better than DMart, which is gaining market share quarter over quarter, we will not be able to allocate in other players. But in fashion retail, Trent, we are very bullish on Zudio. We like companies who in bad times gain a lot of market share, and that's what Trent did, and that's what DMart also did. If you compare DMart to any other grocery chain, like Metro got sold to Reliance yesterday, those numbers are there in ROC. Spencer is a listed company. The numbers are there out there. DMart gained the market share very, and even against Reliance Grocery. So we like companies which gain market share from those other players. Same is the case with Trent. Compare Trent to any other player like TCNS, except Manyavar, because that business model is a little different and more impacted by the marriage season. But in the normal wear, ex-celebration, Trent has scaled. Basically, he's reinvested his QIP money. So Trent had done a QIP before COVID at 500 rupees a share, where Tata Sons had participated. All that cash was reinvested in Zudio. Zudio is like the Primark. Or anyone who's gone to UK would know. Udayan, you're in UK, you know how Primark does. It's the fastest growing retailer. And Noel G is trying to build a Primark out of Zudio here. It's a very super business. And if you think about it, how do you see retailers? We look at inventory turnover. So last quarter, the sales of Trent was 1850 crores. The inventory of Trent was 800 crores. Basically, if your inventory turnover is 7 times, 8 times in a fashion retail business where your gross margins are 50%, it's a very superior business model. So we look at superior business model with high growth. If the business model is superior, it's generating cash, but the growth is not there, then it's useless for us.
Good to hear your thoughts today, Amit. Thank you very much for taking time out for us. We'll catch up with you soon again. Thank you.
Thank you.
If you like the video, do like, comment, share and subscribe.